Hello everyone, Michael here from Adventurous Real Estate Investors. Today I briefly want to discuss capitalization rates, or cap rates for short. The cap rate is the rate of return based on the income that the property is expected to generate at its current operations. The cap rate is determined by dividing the net operating income by the current market value. For example, if a property has an annual net operating income, or NOI, of $100,000 and is selling for $1.5 million, the cap rate would be roughly 6.6%. Therefore, the lower the cap rate, the higher the price, because they are inversely proportional. As either a passive or active investor, it is imperative that you understand what NOI the cap rate is based on. Is it based on the trailing 12 months income, the trailing 3 months of income, or even the trailing 1 month of income? Or is it based on the NOI at the end of year 1 of operations, or perhaps even year 2 after the entire value add business plan is executed? At Adventurous Real Estate Investors, we determine our purchase cap rate based on the trailing income, because that determines the actual value of the property at the time of purchase, not the projected income, because that is only a projected valuation and is based on too many unknown variables. There are a lot of deals out there right now that are trading based on projected cap rates. So make sure you understand how the cap rate was calculated for the next deal you invest in. Until next time, explore more. Adventure awaits. Cheers.